Okay, in the last video we were looking at different types of protectionism and why economies might want to protect themselves from foreign competition. What I want to do in this diagram, in this video, is to bring back a diagram. Trade creation. Okay, it's basically a diagram to show the benefits of international trade. So what you should remember is this. And DOM stands for domestic, so the demand for domestic goods and the demand within the domestic economy for goods and services. And supply domestic is the supply of domestic goods and services. So what you should remember is that without international trade, then we will be at the equilibrium point where demand meets supply, and would mean that domestic consumers rely entirely on domestic producers to earn, to meet their wants and needs in effect. Now, when we embrace international trade, what will happen is there will ultimately be a huge influx of cheaper goods and services from across the world. Okay, so think about what that does. It's going to mean now that demand will be at demand 1. Domestic supply will be at S1. Okay, so lots of domestic firms would leave the market, unable to compete at these new lower prices, so price FT, price free trade. But the cheaper price would also massively increase demand, and the gap from S1 to D1 would measure the volume of imports coming into the economy. 0 to S1 are the domestic goods coming into the economy. Okay, now when you think about it now then, what this means is that this huge green triangle is the consumer surplus that people now earn in the domestic economy. And that's the big sort of benefit of international trade. Consumers get a much better deal. Domestic producers, though, when stands to domestic consumers anyway, their producer surplus is that. Okay, so what we've now got to think about then is, what does a tariff do to the domestic markets? Now, what a tariff will do, it will basically raise prices in the domestic economy. So let's call that PFT, dropping pens now. So price free trade plus T, plus the tariff in effect. Now look at what that does. That will allow domestic producers to produce more within the economy. Okay, so S1 to S2 will have this increase in domestic supply. Domestic demand will fall due to the higher prices. Okay, so what we now get is a few different areas that we can look at. So let's call this A. We'll call that point B. So A is there. We've got B there. This one will be C. We'll call this one E, not D, because we've already used D for demand. We've got F. And we've got G. Okay, now when you think about it, consumers lose a massive area of consumer surplus because of protectionism. So the consumer lost that loss of consumer surplus with the area PFT plus T. PFT B G. So I'll dot that. We've got that. So this huge green box, if you like, is the loss of consumer surplus, that consumer loss. I mean, it's all bad for the economy though, because what we do get from protectionism is a growth in producer surplus. So the producer will gain PFT, PFT plus T, A, C. So remember, you've got this big red box, which is the loss of consumer surplus, all because of reduced international trade. But it's not all bad for the economy because the producers will gain that. And just remember, people need to work, so that could promote job growth and prosperity in some ways for the economy. So you can see that the green box has shrunk. We've also got to factor in what the tariff will do. It will raise government revenue. So we've got imports coming in now equal to S2 to D2. So what we would now say is the government is taxing imports. So the government would win area A, B, E, F. So think about that logically. S2 to D2 are the imports coming into the economy. So the government is taxing all these imports, and the value of that tax, that tariff, is that. So multiply those two sides together, and you get this huge box here. Okay, so the impact of the tariff would be loss of A, C, E, and B, F, G. So let's do these ones in blue. So this is one loss for the society, the economy, if you like. That is the other loss. So when you become more protectionist, you lose A, C, E, B, F, G. And also these triangles will get bigger and bigger depending on the size of the tariffs. You take these tariffs to where you move towards free trade, and you would gain these different areas. So you wouldn't base it purely on that diagram. What you would say is that trade is a wonderful thing. It creates huge benefits for the economy. Okay, the trouble is, nothing's clear-cut in economics if you think about it. Now, free trade. What we know is that one huge benefit is that trade creation. That huge increase in consumer surplus. Okay, now think about other ones as well. That previous diagram is a little bit simplistic. It's looking at how domestic suppliers fare in the domestic market. But with more trade, our firms can export more across the world as well. So our domestic firms can suddenly sell their goods in different economies across the world. It could help them grow, become more successful. And a link to that one as well, because firms are now producing on a much bigger scale, they benefit from something that we call economies of scale. And all this does is a lower average cost of production. Okay, so the idea would be that as you expand production, so you're no longer just to domestic consumers, but on a global or at least a regional trade block level, you've got more customers, your average costs start to fall. This could push down prices even further, which leads to even more benefits for consumers. So other ones, competition. If domestic firms are competing with more foreign firms for business, then consumers should get a good deal. Prices should start to fall, choice will increase, there should be more innovation by firms, more spending on research and development. Linked to that one, prevents complacency. If a firm has built up a dominant position in a domestic market, they can become fat, lazy, inefficient, for example. What competition will do is promote these firms to, well, compete basically. They'll have to compete, which means they've got to become more efficient, lower their prices, become more lean, which benefits customers. Moving away from just trade, another benefit of globalization, if you like, which can come with trade, it's a growth in foreign direct investment and MNCs. Okay, so with the trade, firms look to expand overseas, take ideas and technology with them, could create huge benefits to the domestic economy. But on the previous presentation, I went through lots and lots of different arguments for protectionism. So we have things like dumping, prevent dumping, prevent domestic firms, for example, from competition, protect jobs, protect infant industries, sunset industries. So just sort of bullet point these ideas down there. So domestic jobs, prevent structural unemployment. You've got infant industries, sunset industries. You've got help the trade balance. So economy of huge chronic trade deficits. It's a great way of trying to get it down. You've got the self-sufficiency argument, which is the one where, well, you know what? Do you want to become reliant on foreign firms for goods and services? Is that quite dangerous, or do you need to have an element of domestic production? even if it isn't completely efficient. But what I would say linked to that one is, though, look at all these different arguments here. You've got dangers of retaliation. The higher the protectionist barriers you can put on an economy, then ultimately they're going to respond. They're not going to allow your firms to keep exporting. So overall, is free trade good for the economy? Well, it really depends who you talk to. For some people, like consumers, we would generally argue it's a wonderful thing. If we go on economic diagrams like this one, again, it looks like a wonderful thing. But some domestic producers would be unhappy with it. It's not always fantastic for government tax revenue either. So overall, personally, I think it's a wonderful thing, but there are those that would disagree.